Good morning and thanks for joining us on Business Daily right here on Trust Television. I am Yusuf Akogu. On the show today, we are looking at a very important topic. The Nigerian stock market crosses 100 trillion mark for the first time in the history of the market. Of course, that was achieved on Monday when the year-end deals actually pushed the market to that very historic feat. We look to see how the market will move on in this pattern in the course of the year. A lot of reforms going on. The tax reform is going on, and of course a lot of other issues there also going on as well in the economy that is expected to boost the market. Look at how the market fell in the year 2025. Of course, you saw the all-share index recording a year-to-date gain of 48.1%. That is a very huge gain for investors in the market. Most of the medium and large cap equities that opened the year on a very low price closed very, very strongly, with the like of NCR recording the highest or one of the best performing stocks on the exchange in the year 2025. What is the outlook for 2026? We are beginning to see the glimpse of how the 2026 is going to look like. Let's put this in proper perspectives and hear from some experts who monitor the capital market. I'm being joined by Mr. Adebayo. He is an economist and also a lecturer at LBS. Good morning, Mr. Adebayo.
Good morning, Yusuf. It's a pleasure to be here with you once again.
Glad to have you on Business Daily. Happy New Year to you.
And Happy New Year, Yusuf. Great.
Oh, thank you so much. Talk to us about your rating of the stock market performance in 2025. We understand that the year has begun on a very good note, but before we go there, let's see how your rating of 2025 performance of the Nigerian Stock Exchange.
Okay. So 2025 has been quite an interesting year on the market, especially when you look at it from the perspective that the gains seem to have significantly outstripped inflation. That means if you had invested money in the capital markets, your gains as of the end of the year would not have been taken away by year inflation, if you look at that. Another thing is that, yes, it's not realizable cash until you cash out of the market. But in times like this, where we have inflation where it is, but with a stable economy, you want to be able to enjoy capital gains and have assets that are earning. And these are financial assets, as it were. So they're as near money as possible. They're figures that are tested, that are real, and which people can take advantage of whenever they need to cash out. Actually, I have a 51.1% return year to date between the beginning and the end of 2025. And that's pretty much significant, something quite appealing. I'm about doing a comparison with other markets all around the world, but when we look at the index compared to the nominal rates, like you said, it's past 100 million, but its performance on a percentage basis is actually the best in 18 years. The best in 18 years. So that's a fantastic performance we have, Yusuf.
And talking about the fantastic performance, we understand Nigerian market ended the year as the 4th performing stock in Africa and number 5th in the world, behind the likes of Malawi and co. Given our position in Africa, I know last year we performed very well just behind Argentina. Do you think we are improving, or in a way there's some, a lack of confidence in our market?
Well, I happen to have come across a report, and I will mention the reports written by an analytical company you may have heard of, ProShare. And it's a very interesting report because it's been titled The Billionaires Exchange, and it speaks about the concentrated world within the Nigerian Stock Exchange. The key thing there is that in any exchange, what gives the exchange depth? And when I say depth, it is about the amount of shares that you and I can come in and buy whenever we have the money to buy. The amount of depth in the market is actually quite limited. And that's because when you look at stocks like BUA, you look at some of the Dangote stocks doing well, the free float, which is what is available for you and I to buy, is very, very small. And that tells you that the owners of those companies that listed those shares, they're actually holding on, more like permanent holdings to maintain their percentage control of those large companies. Now, without much depth, you may not find enough room for foreign investors to come into play and take positions. That also means in its own way that there's not enough liquidity in the market when there should be. So these are all situations that perhaps affects the degree of confidence in the market. There's of course also the mention that, you know, Zenith Bank, being regardless of its capitalization, is one of those stocks where you have a lot of depth, a lot of room to play around. And perhaps I should say most of the other banking stocks too have that amount of free float. So a lot of players can buy and sell, consistently play in the market, and foreign investors and pension funds can actually take positions too. So that's it about confidence in the market.
There's something you mentioned which I think we should interrogate. You call the Nigerian market the billionaire market. It does seem that the small traders, the retail traders, are not gaining, because if you look at the top six gainers in the market, you see the likes of BUA, Dangote, Jimovia, Michael Tedola, and co. Do you think the market is positioned in a way that benefits some classes of people?
So I'm not going to use the word benefit at all, Yusuf. It's not about benefits. One thing that's clear is that it is more about how the market performs. You did mention the names of some companies now, and it's pretty clear that those are companies that are seen as performing. Now, there are two things you want to look at. First of all, from an analyst perspective, you always want to talk about fundamentals. And when we talk about fundamentals, what exactly are we talking about? We're looking at the company's financial performance based on its audited accounts. We're looking at its profit margin. We're looking at its dividend yield, its dividend ratio. We're looking at the price to earnings ratio and trying to reset that. Those are typically the fundamentals. But with these companies having so much weight in the markets, the top 10 companies represent about 62.4% of the market capitalization itself. So it just tells you that if half of those companies drop in terms of share prices, the capitalization itself will drop. So that degree of concentration can sometimes bring some worry to persons. But it's not about the individuals. It's not about benefits. The market perceives those companies as ideal for performance. And you can't take it away from the performance of those companies in reality. They are returning dividends to the owners. I did say earlier that Zenith Bank was one of those that had a free float that was quite deep. And when you look at the key owner of Zenith Bank, he's given the percentage of shares he has. He's able to walk away with a dividend of about 7 billion. And that tells you the amount of dividends that were distributed to the other shareholders. You know, so this is actually the way the character of the market itself. It rewards, and I use the word deliberately, it rewards those companies that are able to perform financially and show the right fundamentals for analysts to recommend them to brokers.
Indeed, quite impressive. But where does this leave retail investors?
Well, Essentially, as a retail investor, one of the areas in which one tends to advise you is try not to go into the market as an individual. And when I say as an individual, that essentially means because, I mean, you can't walk into the market to buy shares, you need a broker. So, whilst you may have an individual account with a broker, there's some leverage you can have on the market if you and other people have your funds together in a fund, so to say. So happily, we've got a lot of funds that are actually investing in the markets today. In my days in investment banking, there were some of them that came up that still exist today, and I don't want to just mention names, so it doesn't seem like one is pushing certain funds. But you've got equity funds, you've got funds that look at various types of stocks, you've got funds that want to base their index on performance. So a larger concentration of the shareholding will be amongst the top performers in the exchange. So in terms of asset management, and we're talking of financial assets here, your equities on the exchange, one, you want to be able to spread your risk by holding a diverse range of stocks across a diverse range of sectors at the same time. So you're always playing in one sector that's performing. And if all the sectors are performing, then that's good. So, but you also don't want that to be in just one fund. You may want to take funds across different fund managers. This gives you the spread. This gives you the capacity as an individual to be able to get the rewards which the market has to offer. But when you go in as an individual and you want to make decisions yourself to pass on to a broker, that's a non-discretionary arrangement. You may be too slow or too late because the information available may become old and the decision you want to take may not have the outcome which you had initially thought of. So the advice is individual customers, there is a lot to gain and you can gain a lot as an individual, but you need to play the market through a fund manager or a well-experienced broker. Yeah.
Indeed, there are people who say the Nigeria market, somehow the way it operates, operates different from the larger economy. What we see in other parts of the world is that when there is crisis in the larger economy, it affects the performance of the market. But it's not the case with the Nigerian market. Nigerian market is more like a standalone market. Whether there is trouble in the economy or not, we see the market, doing so well. What do you think? Why do you think that there's more like a separation between the market and, of course, the larger economy, as the case may be?
Okay, so here's the thing. First of all, even with basic economics, the best example of a perfect market where demand and supply works is a stock market. One, two, most times it is said that it is the barometer of the economy of any country.
Absolutely.
It shows a lot about liquidity. It shows a lot about investments. It tells you how much money is being saved because the macroeconomic equation is S equals I, savings equals investments. But when you do say that, it doesn't always reflect the market. There is always a line, a certain gap between cause and effects. So when events happen, it's not always that it instantly reflects in the market. Sometimes it can be faster than other times. But I'll give you an example. Sometime last year, the federal government in the various announcements that were going on regarding taxation, there was an indication about the capital gains tax. And brokers reacted to this. First it filtered out in the news and media. And people weren't sure what exactly, when you hear the news like that, before you act, you want to see that it's on mainstream news. You want to see that it's been reported that a government official said it. So because to take a decision, you want to substantiate that news as a fact. And once that fact was certain that the CGT, capital gains tax, was going to be there, that meant that if I were to get capital appreciation on my investments, on my funds in the market, and I exit and I don't put the money back into the market, then I'm going to be taxed at a particular rate, which brokers saw as punitive. And so for this reason, instantly that week, the market dropped, the largest drop it had experienced in quite a while. However, the following week, it had already been arranged that the finance minister, the Honorable Minister of Finance, Wale Edu, was going to be at the market for the listing of the shares of the real estate investments fund being put forward by the Ministry of Finance Incorporated. And the minister himself is a broker. He's well known to those at the exchange. He knows the exchange, and it was an opportunity to speak to him and to tell him this directly. And he left the exchange telling them that, you know, we're going to do something about this. Guys, don't worry. And instantly, the week after, you could see how the market gradually over 2 days bounced back to its former height. So indeed, the market does react. Then again, you need to bear in mind that where you have the money markets and you have the capital markets, events going on in the money markets tends to affect the capital markets. One of the reasons why you are seeing the degree of activity you have in the capital markets is because what I believe is going on in the money markets in terms of interest rates and inflation being wiped out. You find people looking for long-term gains, because when you invest in the capital markets, you're doing so for two reasons: your returns or your growth in terms of capital gains. Returns aren't always instant. They are long-term, but they are significant. And you can exit at a certain capital gain within a short time if the stock performs. So I see the capital market as one that reacts to events in the economy.
Well, I agree with you, but is the duration of the reaction is what matters a lot.
Yes, yes, there's always a lag, and sometimes the reaction is perhaps a bit more muted than what we may have expected.
Absolutely, more like different from global best practices. Well, let's move on and look at the reforms that we have that we expect in the course of the year. Of course, the tax act, the new tax act, has already the implementation has started. What sort of consequences do you think this is going to have on the capital market?
I don't see it having much. Essentially, the taxation in the markets has always been there. You pay withholding tax on your dividends anyway. We've been doing that for years. There has been capital gains tax from time. Perhaps the only challenges that may come about will be that stockbrokers not being deposit money banks, having certain accounts in banks, it would mean that your cash transfers, or your transfers anyway, between accounts will be subject to stamp duty. The current rule is once it's over 10,000 naira, there's a 50 naira stamp duty. But if you're moving a million plus, you're not going to think too much about the 50 naira or its impact on what you're doing. So I do not see the taxes having so much of an effect. But if you're also talking about next year, I expect the capitalization next year to grow significantly. Earlier this year, I say earlier this year, 2026, sometime in 2025, I should say, we had indications, there were hints that Dangote Refinery intends to list on the exchange. Will this happen in 2026? I cannot say for certain at this time, but I know that if you want to list in 2026, it's a process you would have started. So there are certain persons who are pretty much aware of the detail, what process is being done right now, and when the listing is likely to take place. But it is expected this year. Now, you and I can straight away calculate the impact that's going to have on the market capitalization in nominal terms. And, you know, we can only project in terms of the index and what it's going to look like. So generally speaking, I don't see the taxation affecting activities that will happen in the market this year. And we're looking at some positive activities in the capital markets.
Indeed, positive activities in the capital market. Let's look at collaboration now between the capital market stakeholders and, of course, regulators, which is very, very important. Do you think there's a synergy to boost the performance of the market going forward in this year, 2026?
Well, one thing, remember the exchange is itself a self-regulatory organization. And this is a tradition the exchange has had since the 60s when it was established. We're talking of half a century of legacy experience in terms of self-regulation. So there's no doubt about it in my mind. Regulation is as it should be. The exchange keeps exploring opportunities to be able to allow as many companies as possible step forward and become members of the exchange through the listing of their shares. So yes, that will come on as we go ahead. But the regulators, in my view, are doing pretty well. Beyond the exchange itself comes the Securities and Exchange Commission. Again, they are well trained, they are well placed, they know exactly what needs to be done to continue to encourage foreign investments, to encourage local players, and to make sure that pension funds keep the funds safe within the ambit of the market itself.
All right, let's look at the other part of the market now, talking about the bond market. This is another a very important part of the market that are not usually official, on trading tables, like the equity market where you trade stocks every day. Do you think though some of the stocks, the FGM bond and quite a whole lot of bonds that are listed there are not viable enough for to attract investors?
So I was actually almost going to talk about the debt side of the capital markets, Yusuf. And I mean, you've brought it right up. This has been quite a concern for a while. Unlike money market bonds, which typically are relatively short term, that's less than 270 days in tenure, and they tend to be held and managed by treasury departments. Those are actively traded bonds. On the capital markets itself, the long-term federal government bonds, which tend, and of course, there are some corporate entities that actually have debentures and mortgage bonds listed on the capital markets itself. But these are long-term bonds. And what we find is that most investors in these bonds typically invest and hold. And that's because there's not much depth in that market. There's hardly any secondary market. The primary market is when they're offered to the public, when they're bought and then they're listed. The secondary market is after they're listed, whether there's trading on them. We hardly see any trading at all in that area. But one thing is that the kind of interest rates you've had on those bonds tends to present themselves as suitable for long-term investment. So you find most people wanting to hold to maturity because it's seen as a savings. It's seen as an asset class that gives a pretty much certain return. Because if it's a federal government bond, you can be sure that the coupon payments, which is the interest, the bond will be paid as and when due. And that goes back into the fund. And when it's time to be redeemed, they will be redeemed. So there's a lot more trust for those bonds. And that's why you perhaps find that there is no secondary market or secondary trading in those bonds.
Indeed, impressive. Before we wrap up now, of course, let me ask you, of course, I know it's quite early in the day to begin to predict how the market will end the year. Already, we've seen a year-to-date gain of over 2% already. What are your prediction in the course of the year? We expect a lot to, to have consequences or impact on the market. The inflation number is there, the monetary policy is going to be there, the GDP growth, and quite a whole lot of, macroeconomic indices will have impact on the market. What are your predictions for the market in the course of the year, and what advice do you have for investors who are still holding back?
Well, if you're holding back, I would say you're going to miss out on the market. And personally speaking, I feel I missed out a bit on one or two opportunities in the market, and I'd like to be much more alert to take advantage of that. If, as I had said earlier, we have a major listing in the Dangote refinery there, the capitalization is going to go up, and you can imagine how much cash will be absorbed right after that listing once trading starts. I had mentioned earlier the aspect of the capital gains tax and the fact that if you trade and you receive a cash payment on your stock and there's capital gains, but the capital gains are reinvested in the market, it would not be taxed. What we may see is that the gains which we have seen in 2025 will be traded and will be reinvested in the market in 2026. And the only thing that can happen with that is market growth. Will there be more shares to deepen the market? That remains to be seen. My expectations are that we will have a few more listings. And beyond the listings, then will there also be opportunities, perhaps more funds, gathering funds together, funds that can invest in equity in the market or invest in bonds in the market? I think we'll see some players coming in. Remember that a lot of fintechs are not listed right now.
Absolutely.
So there's an opportunity there. Insurance companies have been toying with the idea of possibly, if they can, doing a bit more with bonds. So we may have that situation. So my timing is up, I realize.
I'm afraid we have to go now. Thank you so much, Mr. Adebayo, investment banker and economist. We appreciate your time speaking to us all the way from Lagos. Thank you so much.
You're welcome.
All right. And that's a wrap on the show today. We'll be back again tomorrow. I am Yusuf Akogu.